Hello and welcome to our commentary of the fourth issue of the Credit Market Pulse, a bi-monthly snapshot of the market-driven corporate credit risk conditions of the capital markets around the world. All the analysis behind the Credit Market Pulse leverages the extensive data and analytical intelligence from S&P Capital IQ, including daily probabilities of default calculated on financial and non-financial corporations via our Market Signals PD model. Following the feedback from our subscribers, we have introduced two new aspects to our June edition. The first new element is a focus in Asia's macroeconomic credit trends through the aggregation of the probability of defaults of non-financial corporations in the region throughout Asia-Pacific and Southeast Asia. And the second element is a deeper review of the credit risk burden of the financial institutions sectors behind the major two indexes, the S&P 500 and the MSCI Emerging Market Index. So moving on to our Singapore office, Michelle, what are the new compelling Asian trends that investment managers and credit professionals need to know?
Overall, the credit trends behind most Asian economies seem to be moderating versus the mid-2013. However, the differences between some of the countries are striking. Let me bring your attention to a less obvious fact. On aggregate, non-financial companies from India are twice as likely to default as its Chinese peers. As you can see, this trend has prevailed across the last 2 years, with India displaying a 2.19% probability of default that maps to an equivalent quantitative credit score of BB-, while China stood at a 0.85% probability of default level, just marginally below investment grade at a mapped quantitative score of BB+. What is also interesting to note in these two cases is the meaningful gap between the median PD score and each country's sovereign rating. This is particularly divergent in the case of China, where the difference is a stunning 7-notch difference between the average aggregated credit quality of Chinese corporations at BB+ versus the AA- Standard & Poor's rating for Chinese government bonds. As we discussed in former editions, these cases illustrate how sovereign ratings can, at times, not be the most direct indicator for the credit health of firms in a country. Changing the angle to Asia-Pacific mature countries, Taiwan and Singapore take the lead with the lowest median PDs as of June 13th of 0.07% and 0.08% respectively, which both fall into the single A score range. Japan, South Korea, Australia, and New Zealand follow the ranking with Hong Kong at the end of the group, with a probability of default of 0.35%. That translates into a BBB- score. When looking at Southeast Asian economies, that is ASEAN, excluding Singapore, the median PD for this developing region sits at 1.05% or BB, which is currently more elevated than China's. Within this region, Malaysia exhibits by far the lowest PD over the entire period, most recently at 0.13% and a score of single A-. The Philippines, on the other hand, have by far the greatest PD, most recently at 3.75% and consistently at the single B level. So, shifting the analysis from the broad macroeconomic trends to the movements of the global public markets, Silvina, what are the main findings in this June report?
One of the most interesting findings of this June issue has been the very contrasting credit standing of financial institutions' constituents within the S&P 500 and the MSCI Emerging Market Index. As we can see in the graph, the credit risk of the S&P 500 index remained very stable at an overall probability of default of 0.04%, mapping to a score of A+. The financial sectors, new to this issue, took over from the telecom services and the sector that had the heaviest contribution in terms of credit risk. But mid-June, and with over 80 constituents, financials accounted for over 15% of the total index composition and recorded a 0.1 probability of default, or a level of A-, just 2 notches below the score of the overall index. The single highest individual contribution was E-Trade Financial Corporation at a 1.55% probability of default that maps to a credit score of BB-. ETFC credit quality, measured through S&P Capital IQ Market Signals PD, has been consistently growing over the last year, raising by 1.37 percentage points year to date, and it has accelerated more since early May. Shifting the gaze to emerging markets, the MSCI Emerging Market Index paints a very different picture. The index has fluctuated from an overall speculative grade of 0.83% that maps to a score of BB+ in mid-2013 to a more moderate investment grade level of 0.53% probability of default or a score of BBB- by mid this year. All the sectors within this index have also shown a much more colorful volatility pattern across the same period, with very few constant observations that rather contradict the findings on the S&P 500. Most notable, the trends are by mid-June are on the one hand a consistently stronger credit quality of both the information technology and the financial institution sectors, with short-term credit scores of BBB and BBB- respectively. And on the other hand, we also wanted to highlight the contrasting heavier contributions of the energy, materials, healthcare and telecommunication services, with respective scores of BB+ for the first two and BB for the later. In comparison to the S&P 500, this emerging market index shows a stronger reliance on financials, which at mid-June this year constituted almost a third of this index. Top largest credit risk heavyweights over the last 12-month period through June 2014 have been Bank of India, peaking at a probability of default of 53.64% or a CC score on the 27th of August of last year. The second one was China Overseas Grand Oceans Group, topping a 32.46% probability of default or a score of CC- by the 20th of March this year. And last, DLF Limited, reaching a 28.27% probability of default or a score of CC- on August 2013. The outliers above come to show the potential sources of credit risk hidden over the past 12 months within an otherwise rather strong overall industry sector subgroup. So, Michelle, moving back to you in Singapore, since we seem to be moving into company-specific performance metrics, what are the companies that top the credit ranks over the last 2 months?
Moving into specific firm performance, June 13th this year found Doro Financial Corporation as the highest PD in all of the regions coming from US, with a probability of default of 40.89%. That maps to a quantitative score of CC-. In the case of BRICS economies, we have already seen the first two highest credit risk names, Russia's open joint stock company Long Distance and Brazil's OISA in past issues. However, the third name, China's Suning Commerce Group Company, is new to the top PD list for the region. It is also worth noting that at the moment, the PD level of Suning at 4.82% single B is the lowest level we have seen for the top 3 spots in the BRICS. The top 2 best improvers in our 4th edition are 2 Norway-based companies. Telecommunications firm Telenor ASA improved the equivalent of 8 notches to a low PD of 0.01%. Financial products and services provider Sparebank 1, Nord Norge, improved the equivalent of 7 notches, also to a PD of 0.01% or a score of AA+. As of mid-June as well, the largest deterioration since our April issue was Hong Kong-based Chong Hing Bank Limited, which rose the equivalent of 11 notches from a PD of 0.01% to 1.73% PD. During this period, 3 insider sales were announced on April 30th, resulting in over 250 shares sold, and on May 8th, a decreased dividend was announced at the annual general meeting. Thank you.
Thank you for joining us today, Michelle. I hope our analysis has provided you with some good insights for your day-to-day business credit decisions. If you are interested in receiving the full Credit Market Pulse report described in this video, or if you would like to subscribe to our subsequent editions, simply access our S&P Capital IQ Credit Solutions website. And also, do not hesitate to share your views and thoughts on the report and any ideas of areas of focus for our upcoming editions. With that, I want to thank you very much from London.